Welcome back to the Fund Blueprint. On today's episode, we're excited to have Kyle Benusa, co-founder and CEO of Ballast Consulting. Ballast is a management consulting practice dedicated to building strong finance and accounting foundations over small businesses. Over the past 5 years, Kyle and his team have supported nearly 100 businesses, assisting with over 30 startup capital raises and a dozen recapitalization and founder exits. Ballast Consulting Group works across a variety of industries, including tech and SaaS, medical services, professional services, retail, logistics and transportation, manufacturing, and oil and gas services. Kyle's extensive experience and commitment to helping businesses thrive makes him a valuable guest for today's episode. Kyle resides in Richmond, Virginia, with his wife and 3 daughters. We're thrilled to have him here to share his insights and expertise with us. Stay tuned as we dive deep into Kyle's journey and learn more about how Ballast Consulting Group is making a difference in the world of small business. Kyle, welcome to the show.
Thanks for having me. Appreciate it.
Pleasure's all ours. I want to kind of dive in and start by saying the early days of a startup, a whirlwind of activity. Founders wear many hats, coding, marketing, and making coffee all on the same day. But amidst the chaos, keeping a handle on the financial side of things is vital. Imagine you're building a revolutionary new app. You got a killer product, a passion team, and investors are actually starting to take notice. But before you can scale and dominate the market, you need a solid financial foundation. The problem is there are so many moving parts, recording income and expenses, planning for future growth, and of course, dealing with those pesky taxes. Kyle, with your experience in the startup world, how can founders avoid getting bogged down in financial complexity? And what are some simple strategies for keeping accounting, FP&A, and taxes separate, even with limited resources?
Yeah, absolutely. I think it's a great question. I think the first place to start is understanding the landscape of roles and responsibilities around finance, accounting, capital advisory, and tax. I think one of the biggest pitfalls that we see with our small business clients, both founders and then small business operators, is a lack of recognition of those roles and responsibilities, and it creates huge gaps in performance, and those gaps go unseen for potentially years, and then when they finally hit, they always hit at the wrong time. That wrong time is subsequent raises or preparation for an exit. Maybe it's a little bit earlier than one expected because of success, and then all of a sudden they go through an audit or a QOV and something blows up. So I think what would be helpful, Abraham, I'm saying that right, Abraham? I think what would be helpful is if we outline how the world as we see it on the finance and accounting for small businesses and those players and those roles and responsibilities. I think that's a great kind of starting point. So we'll start with definitions, and then we'll walk through some kind of common pitfalls, if that makes sense. So definitionally, let's start with bookkeeping and accounting. I'll bucket those as a single bucket for the time being. So bookkeeping, the Ballast definition, is the process of capturing financial information and reporting out to management, owners, investors, etc. But bookkeeping is the basics. It's like bill entry, expense entry, in-process reconciliations. Bookkeeping is kind of the lower level daily functions in the accounting world. We usually distinguish it slightly from accounting. Accounting is the more complex elements related to revenue recognition, expense recognition, moving from cash to accrual. So you've got bookkeeping, you've got accounting, and that's the keeping of records and the keeping of financial records for a variety of purposes. Pretty basic. So that's bookkeeping, that's accounting. Let's keep that in one single bucket. It's usually performed by the same group, same person, same role, etc. The next one is FP&A, financial planning and analysis, which is a very different thing, and we'll talk about this. Unfortunately, for most people, it's too different from the accounting, and there's a disconnect, which we'll talk about. So FP&A, financial planning analysis, it's the comprehension of that information that the accounting and bookkeeping functions are producing. It's an understanding of that. It's a recognition of what it says, the narrative of the business, and it's analyzing it historically, in the present, and then most importantly, it's taking that information and it's building out a forecast and a plan using some fundamental assumptions that were driven by the analysis that was performed. That's the A in FP&A, the analysis that was performed in the historical and the present financials. It's a very different function than the accounting function. And we can talk about that. But don't make the mistake of thinking that those are the same thing. Don't make the mistake of thinking, well, my accountant is, really my controller. Those are different. And that controller is doing all of my FP&A and forecasting. It's not really the same thing. So the first thing is kind of distinguish that those are two different things. The third definition, so the first definition is bookkeeping and accounting. The second one is FP&A. The third definition is tax. And I'm lumping tax into a single bucket. The fact of the matter is it probably shouldn't be, and the CPA would slap me. But let's look at tax and income tax. That's really what we could recall that kind of compliance reporting. So that compliance reporting is usually income tax focused. It is the filing of a federal income tax return and a state income tax return, depending on what state you're in, for the entity or for the investors, and depending whether it's a flow through or full C corp or has an S election. It's the compliance related reporting. That's a very different function than accounting and bookkeeping. That tax function happens once a year. There's usually not a lot of conversations throughout the year, and more often than not, it's filed on a cash basis, which we'll talk about in a minute. But that's a very different function than bookkeeping, accounting. It's a very different function than FP&A. All very distinct. The fourth one, most founders, most small business operators recognize is a distinct function, but I really like to highlight it. That's capital advisory. So if you think about accounting and bookkeeping, it's capturing your financial information historically and in the present. And you think about FP&A as the utilization of the information to forecast the future and plan and understand the business. And you think about taxes, taking that information, giving it to your tax CPA and filing so that you're in compliance with the federal and state laws. Capital advisory is the recognition that more often than not, there is this thing called a capital structure within your organization, whether it's retained earnings and bootstrapped earnings, or whether it's debt and equity, and understanding that stack and understanding the costs of different forms of capital and developing a strategy around utilization of those various elements within that capital stack and providing advisory services related to this. Now, for most startups, what are we talking about? We're talking about raising capital. We're talking about raising, and I'll use the term equity and debt interchangeably because we're talking about SAFEs, convertible notes. They're really quasi-equity-like instruments if we don't want to get too complex. But capital advisory is someone who says, hey, here's how your business is functioning and operating, and here's what it looks like. You're burning through capital. You need to do a raise. Here's the amount you need to raise. Here's how long it's going to give you. And they have some macro element of their analysis. They know what the market can take. They know the investor conversations, but that's capital advisory. So like the first thing that I think is super important, all business owners should be able to distinguish between those four functions and not confuse them for a single function. So that's the first common pitfall, confusing them for one. The next common pitfall that we often see is there's founders and small business owners, and they recognize like, hey, I need to professionalize my finance and accounting. And then they go talk to a tax CPA and they file their taxes and they think they're done. And the problem with that is you're then doing exactly what I said not to do in the first bullet. You're confusing your tax CPA for those other three functions, which they are decidedly not. And that's a really important distinction. And unfortunately, that puts the burden and the onus on a tax CPA that shouldn't be there. Because frankly, they're terrible at it. They're supposed to be terrible at it. They're filing cash basis financials and they have a litany of things that they need to review from a client's perspective. They're not really developing accounting standards. They're not understanding the flow of capital through a firm or a business throughout periods, right? Days, weeks, months. They're not helping with cash planning. They don't understand working capital. I mean, it's a fundamentally different thing. So don't confuse the four functions, and certainly don't use your tax CPA as a stand-in for those four finance and accounting functions in your business. The last thing is just like, I'm going to get on my soapbox. I can talk about this for hours. But it's ignoring the integration that should exist between the FP&A function and the accounting function. So let me explain what I mean. More often than not, most founders, most small business owners, they start to recognize this distinction in those elements that I described, but they don't really fully understand it, and they need to go raise capital. And so in order to go raise capital, they go build a really pretty financial forecast, or whatever you want to call it, forecast or a model. You know the term model used often. So then they'll build it out. They'll be like, all right, well, here's rev, and here's what happens to rev over time, and here are my unit economics, so let me translate it to rev into COGS, cost of goods sold, and here are my margins, and this is what it looks like, and this is great. Let me go raise money on this. But the fact of the matter is that's never really rooted in the accounting. So that disconnect, that fact that you have this model that's sitting out that you use to raise money, that's never reviewed, never reconciled, never adjusted, never actually represents reality, right? It could be like very disconnected from reality. And then furthermore, you're getting to a point where, hey, investors want to report. They want to understand what's going on in the business. Well, like, if you built this financial model in the absence of understanding the accounting, the process of going and updating that is a total bear. I mean, it'll blow a founder's quarter up. When they have to spend weeks going through the financials, understanding it, then translating it, and it was like, oh crap, we never developed the accounting standards that match with the way we think about this business. Let's say it's a market business and it's GMV and take, getting to net rev. So there's this huge disconnect. It blows up. And so like the first thing that we always tell our clients, like once they recognize the landscape, you need to integrate your FP&A function with your accounting function. You need to develop your accounting function to serve the FP&A function. You need to develop that accounting function to flow information into that FP&A function, and that FP&A function should inform the way that you've built that underlying accounting system and structure, which we'll get into in a minute. So that's kind of the third pitfall.
I have to say, solid points from an accounting perspective. I want to move on to talking about accounting, particularly when it comes to good accounting. Accounting might not be the most glamorous aspect of running a startup, right? But it's really the foundation upon which everything else rests. Without a clear understanding of your financial health, making informed decisions could really become a guessing game. With your experience, you've seen many startups. Many startups see this as really a necessary evil. How can we shift this mentality and move toward establishing strong accounting practices? And what are some key factors that you believe that could potentially contribute to that good accounting in a startup?
Yep. So let's first start with defining good. I like doing this with clients. Let's define good. And I think what you'll learn is that most people's definition of good in the finance and accounting world is not aligned. So Ballast's approach, my personal beliefs, Jack Allen, my co-founder and our COO, we define good as information, financial information that is accurate, it is timely, and it is useful in analyzing. But what's super important to recognize, those three things exist in tension. So the more work and effort that you put in to tie out the pennies and get everything 100% accurate, it delays the close, which we'll talk about during the rhythm section of this conversation, but it delays the close and provides the information at such a date where you're like 5 months down the road. Well, small businesses and startups can't have a delay. The last little element is the useful in analysis. So more often than not, the founders, they choose timeliness, they understand accuracy, they tie everything to cash basis financials, and then they get reported within 2 days of the close, but you can't do anything with the information because again, it doesn't represent the way that you think about the business. So good is accurate, timely, and useful in analysis. Your next question was, if I remember correctly, you said, define good, but tell me what makes good, which is a wonderful way to think of it, right? So if good is the result, how do you ensure that you get good financials, right? I will say that I think this is where Ballast has developed a really unique approach or perspective on this. The world often thinks that good is the result of a lot of hard work, more and more hours. Just tie out those dollars, you'll eventually get there, right? And we think that's a load of crap. And what we have learned in this day and age is that good accounting, the way that I've just defined it, is the result of another three things. And these are super important. We'll go through them. The first is systems. The second is structure. And the third is process. So when you agree with the definition of good, you say, okay, how do I get good? The first thing you need to do is you need to map out all of the systems which hold any form of information which eventually translates towards financial information and flows into an accounting system. Back in the day, these used to exist in like a little black box ERP system. Small businesses don't have big ERP systems. They're not using SAP and Oracle. They've got generally general ledger, like viewed as like the hub, right, on the wheel. It's their general ledger, but they have time tracking systems and invoicing systems, AR management platforms, AP management systems like Bill.com and Ramp. They've got credit cards, bank accounts, payroll systems, all existing outside of this general ledger. Those are the spokes. So like when you map out all of those systems and you understand the flow of those information, what you can do is you can build a lot of efficiency towards the creation of the accounting information so that you don't have to do a lot of the work. A lot of the consternation, the pain exists because nobody mapped out the systems and understood how they flew to the general ledger. So that's the first thing, systems. This next one is something we're zealots on, and it's the underlying structure. I want you to visualize you walk into a store, you buy QuickBooks off the shelf. Obviously nobody buys QuickBooks that way anymore. Back in the day, you'd buy CD at like Office Depot. And you put it in your computer, you go to QuickBooks Online and you set it up. That is an off-the-shelf system. It comes with an off-the-shelf structure, which is the underlying organization within that accounting system. The problem with that is QuickBooks didn't design that structure for your business. They don't know what your business is. And they got a little better in the beginning. They're like, are you manufacturing, right? Like, are you services? What are you? It's crap. It's bad. In reality, what you need to do is you need to go through and organize the underlying structure within your accounting system to capture information for the business that you are. I use this analogy all the time. You're probably too young, so I apologize. But did you ever see the movie Ferris Bueller's Day Off?
I heard of it, haven't seen it though.
Okay. In Ferris Bueller's Day Off, there's this character. His name's Cameron, okay? And he lives in this home. And the main character, Ferris Bueller, describes the home and he says it's very large, it's very cold, and you can't touch anything. It's this beautiful architectural home. Glass, steel, concrete, beautiful art on the walls. Okay, I want you to visualize this. I want you to think of your accounting system as a home. All right. The design of that home was for the purpose of a certain form of use, just like your home. That home in Ferris Bueller's Day Off was designed to be beautiful, very large, very cold, can't touch anything, right? It's probably wonderful for a cocktail party with a bunch of stuck-up Chicagoans, right? The movie takes place in Chicago. You can't raise a home in that house. Now I want you to picture a standard prairie home or like a 5/3 colonial, right? In the suburbs of Richmond, Virginia. Those homes were designed for families. And what's fascinating is that that structure of those homes will determine what a pain in the ass it is in order to function within those homes. Your accounting system is the same thing. So even though that home was built with the same steel and glass and bricks, the design of those homes was for certain functions. You have to design your underlying accounting system for the function of the business, or what will end up happening is you shove 7 kids into that glass home and they're going to break all the art. And that is what we see with our clients and their accounting systems. So you map out the systems, you design the underlying structure like an architect would a home that represents the way you think about the business. Next is process. Process are all of the functions that fill that home, fill that structure with the appropriate accounting information so you know what's going on in the business. If you do the upfront lift of mapping and choosing the right systems and designing the underlying structure and then understanding the flow of information in that general ledger, within reason the accounting system will take care of itself. If you make those mistakes upfront by never doing that, you will have a royal mess which needs to be cleaned up at a later date and will actually cause more pain over time. So you asked, how do they do this in a way that doesn't hurt? Shut up, sit down, do the work up front, map out the systems, underline the structure, or hire a group to do it, and then understand the processes that flow within that accounting system.
I have to say, solid points. I like your analogy from a home perspective when it comes to dealing with structure, because that really is the case. I mean, if you don't have a solid structure, everything can come crumbling down. So I think it's important to do that 100%. It's interesting because numbers are the lifeblood of any business, right? But financial data can feel like a jumbled mess without the right tools to interpret it. So imagine you have like a treasure trove of information about your startup. You got your customer data, you got your sales figures, you got your marketing performance. It's valuable, but deciphering what it all means and using it to make smart decisions is really another story entirely. That's where financial planning and analysis comes into play. Some might call FP&A the crystal ball of startups. So how does FP&A utilize the raw data from accounting to inform strategic decision making?
It's a really good question. And one where there's a lot of pushback in the world, to be frank, because more often than not, because the accounting wasn't set up properly, it doesn't represent reality. So there's this like, hey, we're not going to look at it. That's not my business. I just do this to make my tax CPA happy. I think what you're touching on is that good FP&A that's integrated within the accounting of the business. You called it a crystal ball, but it's this fundamental analytical framework that we use to inform decisions within the business. And I think your question is, well, how do you do that well? I think if you understand the business and you understand the flow of information through that business and the way you're capturing the information in the accounting system, if you use that information and build a financial forecast, you're forcing yourself to understand what the common denominator, it's a term we use here, the common denominator, the common unit within that business is. So we like to say this to all the kids coming through here and going through training programs, but it's like that underlying thing within the business that causes a change in costs and rev over time. So it forces you to simplify and understand what that common unit is within your business that is fundamentally driving revenue and driving COGS, and it understands costs and rev relative to that common unit. Absent FP&A, really hard to do that. So like if you're a professional services firm, that common unit is hours. Even if you don't price your contracts as time materials, your common unit is hours, right? Like your costs are going to go up when you have more hours, your rev's going to go up generally speaking if you're doing a good job when you have more hours. It could be contracts, it could be days for a restaurant or weekends for a restaurant. So FP&A, if you do it right, and it's the accounting information, and you understand that common unit and economic within that business, you can forecast it relative to that unit over time, you can grow that unit over time, you can make assumptions relative to that unit over time, and you can test those assumptions over time to understand if you actually understand the costs that are driven by that unit and the revenue that that unit is driving within your organization. So forcing that common understanding of that unit, super important. The second thing is using FP&A. It's like broccoli. It's forcing management to come together, broccoli on a meal. It's forcing management to come together and develop a plan. It's as simple as that. It's like, hey, we all need to get together. What do we think about this business? What do we think is occurring? Hey, here's what's actually going on. We have our own theories of the world. How do we want to build this business and how do we put it on paper? It forces management to come together to understand hiring timelines, role responsibilities, compensation models. It forces management to come together on rates of growth and pricing models. It forces alignment with the management team and the operators, which is also why I think this should be published. I think FP&A should be published, and I think the organization should understand it. The third, this took us a while to figure out and understand, it provides an extraordinary amount of materiality to things that don't sound material today. So this is the other thing. If you're a mom and pop business that's like, let's say 5-6 million a year in rev, you're like ticking up 4 or 5% just over your rate of inflation over a year, like you generally understand your financials if it's cleaned up, and you understand the impact of decisions. I cut this individual, this is what happens to the comp structure. But with startups aren't trading on today's value based on what they're doing today. They're trading on a future value based on a variety of assumptions and you hitting certain targets, right? It's like picturing someone shooting an arrow into the distance. If that arrow and the person who's shooting it is off a millimeter, you hardly can understand the importance of it. And you're like, so what, right? But if what you realized is after they let go and they shoot it, it ends up 3 feet high of the target. Now all of a sudden it adds materiality to the recognition that the person was a millimeter off to begin with. So that's also why people it's this fundamental disconnect with most small business operators. They're like, I can't predict the future, so I'm not going to put together a forecast that's 3 years out. It's like, that's not the point. The point is to add materiality to the fact that if your labor has been changing over the last 6 months and it went from, I'm making this up, 24.2% of rev to now 20.4.3, 0.4, 0.5, 0.6. If I extrapolate that over time, buddy, you're losing money in the next, 18 months. And they're like, oh, I need to address that today. So your question was, how does FP&A form a form of crystal ball for these small businesses? It's a pretty basic concept from our perspective. First, recognition of this common unit, like I talked about, understanding what's driving the cost and the revenue of the business, forcing management to come together to understand what the hell is going on in the business and where they want to take it. Super important. And third, providing materiality to things which may not seem that material today.
Great points. As a founder, I actually have no clue what FP&A is, so I'm happy that I'm learning from this as well. I wanna dig a little deeper into this actually, and as you mentioned, FP&A it can be a powerful tool for startups, but sometimes the complexity can actually bog things down. So I want to also provide an analogy because I know we've been providing a lot of analogies, and I like that. Really, it really helps our listenership and our audience really get an understanding of what the individual is trying to say by having something to refer to. So think of like building a spaceship, right? You want to build a spaceship to reach the moon, but you're really getting stuck designing a hyper complicated control panel, right? You need a system that gets you where you're going, but it's also easy to navigate. With limited resources, why do you think it's crucial for startups to keep their FP&A practices as simple as possible? And how can really founders strike a balance between keeping these things clear and actionable while still ensuring that the model is sufficient for their current needs?
That's a great question. All right, let's look at it this way. So we have this saying at Ballast that we love to say, and it's FP&A should be only as complex as necessary, and it should be as simple as possible. We think of complexity in business as like a form of decay, like it's going to happen over time. So your business, as it ages, every day will become more and more complex. More players, more opinions, more clients, more customers, more cost drivers, more depth of the P&L, more complexity, right? And so if you drive home the point with clients and founders and entrepreneurs up front that FP&A should be simple, what it does is it creates this foundational element within the business that fights against that complexity over time. You can always do ad hoc analysis. You can always dig in on customer client profiles or project profitability. That doesn't mean you have to incorporate that within your FP&A process. We have this rule, generally, to hold ourselves accountable to this. And it's if you're in a meeting with a client, the monthly briefing, let's call it, which is that rhythm and cadence where you're reviewing everything you go through. And they provide you a list of things like, hey, what if? You should be able to update the core assumptions and understand the impact on 5 to 6 key metrics in the business within 2 hours. If your financial model is so complex with like 37 tabs, referencing like 4 other sheets and pulling in a bunch of macro data, you're not going to be able to answer that question in 2 hours. Well, you know how this works. If you can't answer that question within 2 hours in a follow-up with that client, they get distracted, they start moving to other things, the problem doesn't even come back up till the next week, then all of a sudden they never asked Like, understood why I asked the question to begin with, it's not answered. You're like 3-4 weeks behind before they can actually address the decision within their business, and it slows everything down.
Right. Great points. I want to talk about bridging the gap now, between startups particularly and how it's integrated into FP&A. So running a startup is a constant exercise in calculated risk taking and strategic decision making. But without a clear understanding of your financial health, these decisions become as if you're really like driving blindfolded. So here's the thing. Good accounting is like the engine of your startup, right? Meticulously tracking every fuel source, like your income and the expenditure, your cost. But an engine alone doesn't tell you where you're going. That's where, as we addressed earlier, FP&A comes into play. FP&A analyzes the engine data, which is like the financial information, to chart the course and optimize the performance. So with this understanding of accounting and FP&A, how do these two functions really work together to create a smooth financial rhythm within a startup?
That's a good question. So, the first thing I would say is understanding the non financial elements within the business that are driving the financial elements. We talked about that earlier, the concept of the common denominator, the common unit. Find out the few of those common units that are driving those elements within the business and understand how they actually translate to the financials of the business. So, I'll give an example. We have this like ballast letter, we call it, where basically Kyle has an hour and he gets to write his thoughts on a topic, right? We did one the other day, it was on whatever you want to call it, rev ops, sales ops. It was on sales funnels and sales funnel management and analyzing the metrics. But let's go through a real like basic example. Let's say you've got an P&L, you got rev, you got COGS, you got margins, and you break your cost in a variety of buckets. The first one is like product development and R&D, unless the tech team says yes, capitalize it. The next one is sales and marketing, and then the rest is G&A. I can look at that P&L, and I can understand rev, and I can understand COGS, and I can understand margin, and I can understand sales and marketing, and I understand profitability, and I understand what's going on generally with earnings within the business. But what that doesn't do is understand all of the efforts that are going in that are driving that sales funnel and the translation of that sales funnel to bookings, which is a non-financial metric. It doesn't show up on the P&L, which then translates to revenue within the firm. So FP&A is the requirement in this moment to map out those systems and understand the structure and understand the processes of those non-financial elements so they eventually translate to the financial elements within the firm. It's tough. It's super hard. But what's really hard is if you don't build accounting and FP&A to begin with, you have nothing to root that analysis to. It's just this floating, use your space example, right? You said we're building the spaceship, right? Imagine if instead of the International Space Station, where we collaborate with other countries and we build modules and we connect them, imagine if we were in space and Todd's over there building his unit. He's not connected to me. No really understanding of his orbital trajectory, what he's using, whether it's metric or USAE metric system for measurement, and then all of a sudden we have to connect the two. Like, imagine the miscommunications that occur. You have to root all of that analysis eventually within the financials of the firm so that you can understand if your assumptions that you made were right. I can't tell you how many times we sit down with clients and they don't understand how the unit economics that they've drafted on a piece of paper are not translating to the financials of the firm. And it's because they didn't take into account utilization or non-absorbed costs or min-fixed pricing structures. Like, it's not that one is right or wrong. It's understanding the translation of that information, how it eventually gets into the financials, that actually matters.
Great points. I mean, I've definitely learned a lot today. I have no accounting background. A majority of our founders don't, but I could say that I learned a lot about FP&A. So I'd like to really thank you for tuning in, for taking the time to speak with us. We hope that you enjoyed our conversation with Kyle from Ballast Consulting and gained valuable insights into building strong finance and accounting foundations for startups. If you want to learn more about Kyle and the incredible work that he's doing at Ballast Consulting Group, be sure to check out their website and social media in the show notes. Don't forget to subscribe to our podcast for more inspiring stories and expert advice from the leaders in the startup world. If you enjoyed this episode, please leave us a review and share it with your network. Thank you for listening, and until next.